Hello traders, hello trade pros, hello YouTube, hello everyone that's watching this video. Thank you for coming to our channel and watching our videos, and in today's video I am going to present futures trading with commodities. So we're going to be talking about gold. It's one of our favorite commodities. It's one of the better known commodities, if you will. I'm sure everyone here has heard of gold and futures as well, but we're going to break everything down for you guys, and towards the end we're going to just dive into how we trade gold and how we trade this specific commodity, how we trade futures in general with a super top secret strategy. No, I'm just kidding. It's something that a lot of people know, but we're going to explain it to you guys in a lot of detail. Now, this is a strategy that I'm sure a lot of traders might use in different ways, have known before, but whatever it may be, hope you guys are excited. Just by the sound of that, you guys can see right here on TradingView, we got it set up, and we're going to dive right into this. So I want you guys to sit back, enjoy the video, relax, and take some notes, learn some things. That's why we're here. We want to help you guys learn. Now, if you would be so kind to hit that subscribe button if you're not already subscribed. I know a lot of you watch these videos and are not yet subscribed. Ring that little bell to notify you when we do go live and when we drop videos like these on the weekends. And also drop a comment down below and smash that like button. So let's go ahead and jump right into this intro and we'll break everything down for you guys. Now, when it comes to futures, right, and gold as a specific commodity, we have to understand what the specs are. So each contract unit has 100 troy ounces of gold, right? Because a contract is typically used as a hedge. In these days, we use futures for speculative measures to make money, right, in terms of speculation, but oftentimes used for a hedge. And physical futures actually have deliveries. So that means that if your futures end up expiring, right, and you've made a lot of money on the long side, for example, or whatever it may be, and you're long the futures, you could get exercised and you could see however many hundreds of troy ounces show up at your door, right? Maybe not at your door at a storage facility, but that is the case with physically settled futures. And that's the case with oil, a commodity, and gold, a commodity. So we go by US dollars and cents per troy ounce, and you can see they're denoted by tens of cents. So $0.1, right, in US, or every tenth of a cent, right, will go, let's say the price is 1770, then the next price above is going to be 1770.10, right? It's not going to go by 0102, and then the one below is going to be 0.90, right? So they're in 10-cent increments on the pricing ladder of the gold commodity. And each 10 cents of movement, which is one tick, right? There's going to be 10 ticks per dollar movement, and each 10 cents is going to be worth $10 per contract. That means, let's say you get long at 17, right? 1770, and it goes up to 0.50, right, on one contract. It's moved up 5 ticks, right? 10, 20, 30, 40, 50, meaning that you are now to the green $50 per contract. Now, these moves happen very quickly, as you can see on gold. Typically on gold, you get these pretty wild moves. You can see what happened yesterday. We went from 1771.7 all the way down to 1737.80. So a pretty substantial move of about $30 right there. So $30, right? This isn't tens of dollars we're talking about, because $1 is worth $100 per contract. So $30, right? We're talking about a $3,000 potential gain or loss on just a single contract of gold. So understand the contract specs, right, is going to be very important, because then you know exactly what you're doing, what your risk is, what you're trading, so on and so forth. Now, typically, futures, right, they open on Sundays, and they open at 6 p.m., and the pit usually closes on gold at 1:30 p.m. Eastern, right? So this is Eastern time. They do trade later on in the day. Obviously, it doesn't just shut down at 1:30, but that's kind of where the volume starts to die off. Now, we close at 6 p.m. Eastern, and then it reopens naturally every day, but you can see volume kind of starts to stagnate into the afternoon. Now, the 1:30 pit close after that, there could be some movement, but it does get a lot slower. So with gold as a commodity, we have to know that like I said, it's going to be physically settled, right? The settlement method is deliverable. It's not just cash settled. So we got to be very careful with that, and it's found on the COMEX exchange. So with gold, right, as a commodity, it has a pretty big influence, or it's influenced by the dollar movement, right? And typically, it's looked at as a safe haven asset. So before, in correlation terms, it used to move against equities, right? Because it was more of a safe haven, and then equities are more of a risk-on assets. So if we go to a website here and we look at the past correlation of gold with other assets, so here it is, MRCI, and we can use different days of correlation. So let's just go to 180-day correlation. So if we look at gold, symbol GC, right, in most exchanges, so that's going to be somewhere right here. And the first 1, 2, 3, right, 4 are all equity futures. Now, if we look at them and we compare 1, 2, 3, 4, over the past 180 days or half a year, we have just barely negative correlation, right? A very strong positive correlation is going to be a very big green number. A very weak, right, negative correlation is going to be a big red number. Now, we are nowhere in any of those ranges, right? We're not on the spectrum here. We're kind of in the middle in no man's land. So if we go to a 120-day correlation, for example, there is more of a negative correlation with the NASDAQ and the S&P 500 and gold, right? In a 90-day correlation, you can see a very big difference. A 60-day correlation, right? We drop back down. So it varies. It varies on the risk. It varies on the dollar, right, the U.S. dollar. And you'll see that there's a pretty inverse movement with the U.S. dollar and gold. So keep that in mind. It's not necessary that when we see the S&P 500 rallying, we're going to see gold falling. So it's very supply and demand driven, just like most commodities are. Remember that. So if you follow monetary policy, right, you're going to see the effects of the gold asset and other commodities like that are affected by monetary policy, like the dollar, get larger swings and moves. So if you're going to trade gold, you should look at the US dollar. So DXY maybe. So if we compare these and we take a look at them, you can see like we've got the DXY in the orange right here. And for the most part, they're inversely correlated, right? We get a big drop in gold. We get a spike in the DXY, right? The US dollar index. We get a big push down in gold. What does the DXY do? It starts to rally here in orange. So you can see right now we're at plus 1.9% on the DXY, and then we're down 1.58% on the gold commodity asset. So when you're trading this, it's important to take a look at the DXY and see what it's doing. It could give you an indication of what to do with gold, right? Where gold may be headed, what it's doing. Now that we talked a lot about gold, right, the specs, the important parts, whatever it is, the next step is take a look at a strategy, right? Trading the commodity. So trading the commodity is going to be very interesting because it involves volume profiles and distributions. Because what we want to do is, rather than fiddle around too much with support and resistances, we want to make sure that if we're day trading this or if we're swing trading this, we understand the concept of like value areas, how we escape from them, what the moves may be, so on and so forth. So should I say that we grab this ledge right here on the volume profile, right? Why don't we make this a larger box, right? If you want a video on volume profiles, we've got a few on our YouTube channel, and we'll put another one there. So we're trading this particular day right here. Let me show you guys. We're trading this particular day right here. So assuming that this day does not exist, we are looking at the prior day to get our information, right? And the idea is if you want an edge in trading, you have to play, right, through distributions, I find, right? I personally, my edge comes from understanding that price gravitates towards volume, and when it escapes a volume ledge, it has the attraction to a next volume area, right? So to the downside, next up volume area, even though it's small, could be down here, for example. So the idea is I want to understand where volume gets cut off, where the ledges appear and where volume drops off. So based on this current day, after it finishes, I understand that very well, right? Even if price is down here, I know that the volume is super thin on the downside, right? Even if it dropped and I'm looking at this, it's large volume, but if I see what it's done down here, it's not very impressive. Yeah, there's a little belly, but it's not that impressive. Right here where it falls out of the ledge, that's going to be an impressive area. Right here where this ledge starts, that's going to be an impressive area. Because again, once volume evaporates and price goes through that, it's very easy to make this move, right? It's a very easy move if there's no volume blocking you. So for the next following day, what we're going to do, very simply put, we're going to outline a support and resistance based on volume, right? Now we could play this value area if we hit this resistance time and time again. But once we escape this resistance, right, by a few ticks or a few points, we're going to look for the next distribution, which happens to be somewhere here. Right? These are just daily volume profiles. If you want to look at a wider scale and you're swing trading it, we could use the visible range volume profile here on TradingView. So when price comes in, what we're looking for is to see if there's failures at this area, and we can look for shorts which just stops above, right? Just in case it flushes that volume. And the idea is play the distribution, play within the distribution. Right? The targets are going to be at the bottoms here, and if it breaks out of distribution, great. You know where it's going. This little distribution right here. So remember, there's a lot to learn with volume profiles, and we have great videos on our YouTube, and if you want to learn more about that there. But that was just a quick little update on a trading strategy for gold, right? And this works for other futures as well. But the commodity assets, right, they're very supply and demand driven. So when you find something like a correlation, like the DXY, the US dollar and gold, it helps you a lot with that. Now, understanding the distributions and volume profile to trade this is another huge plus. So having said that, learn about the specs, learn about the correlations, and learn about volume profiles to get that edge in trading commodities. So I hope you guys really enjoyed this video. This was Victoria from TRADEPRO Academy, and we'll see you in our next video. But before I leave, remember that I want you guys to hit that subscribe button, because a lot of you guys are watching this and you haven't subscribed. For more great content like this, just hit that subscribe button and hit that little bell to notify you when we drop videos like these, and go live and smash that like button. So thank you all, and we'll see you in our next video.